Good morning, I'm Adam Grimes. I wanted to take just a moment today and share something new that I'm doing for you on my blog. So if you go to my blog, which is adamhgrimes.com, you'll notice over here in the side menu there's now a market stats link, and you can click on Intraday Stats. And you can just bookmark this page. So this URL I'm going to update several times a day, and I will tweet when it's updated. What I've done is I've taken I've created a lot of different scanners and a lot of different market overviews over the years for many different purposes. Whether tracking positions in a large, relatively static portfolio, all the way down to day trading very actively. And what I've done here is condensed what I think is the most important view, the most important perspective of the market. And of course, there's a lot of scanners and things that you can buy, but this is free. And the trade-off is that I'm going to kind of update this on a best efforts basis. So, certainly don't look for it to be updated every 15 minutes is probably a good way to say. But let me also walk you through the sections of the stats page and just talk about a few things. So here on the left, you have a quick overview of major world markets, starting with domestic stocks, S&P, Russell, NASDAQ Composite, world stocks. Now keep in mind that these Europe and Asia will be out of their regular trading sessions for most of the time the U.S. is open. And then some currencies, U.S. dollar index, 30-year treasuries, and three important currencies. And then just a brief look at a couple commodities, gold and crude. Now with all of these, I do give the last price. It's probably the least relevant thing on the screen. And then the percent change. So this is the normal thing that everybody's looking at. When you say Japan is down 2% on the day, fine. But is that a big move or a small move? And the answer to that, and the most important thing that I look at, and the way that I look at the majority of markets, is to use what I call a sigma spike. And what this does, it's a tool adapted from options trading. Option traders use things like this. Just simply looks at the day's return. The day's change is a standard deviation of the last 20 trading days. And everything you learned in school about the rules of thumb with standard deviations does not apply here, because this is not normally distributed, and you'll see in a moment that you will see some very large moves that you would not see if normal distributions applied. So forget that. But basically what you need to know here, if this number is 1 or less, then it's probably a pretty small and insignificant move. And you'll see as you look at the charts with these, you'll see there's a direct tie in there. Anything over 2 is a substantial move, so you need to be aware of this move up in the euro today. This is end of day Friday. Also, I should have mentioned that the sheet will always be timestamped, so last time it was updated. And certainly anything over 3 is a very large move, so we need to know what's going on with Japan that day. The last column is what I call the close is the percent of the range. And what this shows is just a very quick, and I wrote about this in my book, just a very quick way to see where the market is trading in its day's range. Now be clear that this does not refer to yesterday. So you could have a situation, if you look over here with the major indexes, and they're all trading near their highs, and they could very well all be down for the day from the previous close. So it's two different ways to measure strength. I think this idea of looking at intraday strength from the open and in relation to the day's range is very important. So then over here, where is the strength coming from or the weakness coming from in the U.S. market? So the sectors will be ranked by their percent change for the day, a quick look at what is lagging, in line, leading, strongly leading, and then the same measure of the close, and the 2 dots, the colon, by the way, is the open. So you can see that most of these indexes opened on their lows and traded up to their high. Excess return is simply the change for the index minus the change of the S&P 500. So it shows how much excess the index is over or under the S&P 500. And keep in mind, all of these numbers are rounded, so you may see some math that looks a little bit strange, but it's just rounding. And then we get down into the individual stocks. And I give a very quick overview here of tracking a universe of about 1,000 liquid active stocks, maybe a bit less, I think. And this looks at the percent of stocks above today's open. That's one of the secrets, if you will, of tracking intraday strength, is referring to the current open as your reference point rather than the previous day's close. And I also give that stat too. Sometimes you'll see some differences there, and this just gives you an idea, with 85% of stocks above today's open and yesterday's close, that's probably a strong day, probably a trend day, which if we are short-term traders is what we care about. Percent of stocks with range greater than their average true range, and then the average range of stocks in the test universe expressed as a percentage of the average true range. So you see here it's about 100%, meaning stocks are trading with about their average range. And then we get down into some specific setups in the market, some specific stocks, and I give stocks here that are moving with a large sigma spike. Now this is important because remember, these are adjusted for their own volatility. These are the stocks that I want to know about, the stocks that are making big moves up and big moves down, up on the left, down on the right, based on their own volatility. And the exact number here is not critical, but this does give you some measure of stocks you want to pay attention to. And then over there, 3 columns here, this is the sigma spike. All of these are sigma spikes from the day's open for that stock, up and down. And then there's the gap open. So the change from yesterday's close to today's open also expresses a sigma spike. Down here in the lower left, this is the stock's volume expressed as a multiple of its average volume. And the same thing with the range. So you see stocks that are trading with high volume, stocks that are trading with high range. And then last, just a quick look at the gaps in the market. In my test universe, this is the number of stocks that still have open gaps. So what I mean by an open gap, if you have yesterday's trading range here, this is an open gap where you have this difference between today's low and yesterday's high. You have that space open, so it's or vice versa, it could be below, right? But you have that gap still open. It's not closed back to the previous day's range, not the previous day's close, just into the previous day's range for the open gap here. And then a list of stocks, the stocks that do still have those gaps open. A lot of day traders trade off of gaps, and you do need to be aware of those. Sometimes when the market is really crazy, there's going to be a lot of these, and the sheet won't even try. If there's more than 100 or so, it'll just say many gaps. So that's what I have for you, and I will be updating this. I'll tweet when it's updated. I think this is a good tool. It's an important tool for day traders. It's also an important tool for longer term traders, not for longer term investors who should not be focusing on this. But if you're a swing trader, you certainly need to know how the sectors are developing, and where the strength and weakness is within the market, and this can give you some insight into that. And last, like I said, I will update this on a best efforts basis, but there will be some days that I don't, some days that I do more often, so just expect that in advance. And if you have any questions or comments or thoughts, I do welcome them. If you go back to my blog, probably the easiest way to get in touch with me is there is a contact in my about. You can send me an email there, or you can also reach me at adamhgrimes@gmail.com. Thank you very much.